Drake walks into his bank to ask about a fee. The teller barely looks up. 2 hours later, Daniel walks into the same branch, same bank, same day, and within 5 minutes he's sitting in a private office with someone who already knows his name. Same bank, same building, completely different experience. The difference isn't luck, and it isn't who you know. It's a number sitting in an account, and the bank has quietly built an entire tier system around it. That system has real, published thresholds, not vague wealthy versus not wealthy guesswork. We're walking through every rung of it, from the account that costs you money just to exist, up to the tier reserved for a small number of very large balances. Quick one before we get into this. If breaking down how money actually works behind the scenes is useful, hit subscribe, new video every week. At the bottom tier, the relationship runs one direction. Below a few $100s in checking, most major banks charge a monthly maintenance fee just to keep the account open, usually somewhere around $12, unless you meet a minimum balance or set up a qualifying direct deposit. Miss it, and the fee eats into whatever's left. An overdraft, where you spend more than what's actually in the account, can trigger an additional charge on top of that, sometimes more than $30 per transaction. None of this is a scam. It's disclosed in the account agreement nobody reads at sign-up. But at this tier, the bank isn't trying to build a relationship with you. It's covering the cost of holding your account at all. You're a line item, not a client. It's also worth knowing this isn't spread evenly. According to Consumer Financial Protection Bureau data, roughly 9% of account holders generate close to 80% of all overdraft fee revenue, and people earning under $25,000 a year are charged an overdraft fee at nearly 3 times the rate of people earning 6 figures. A rule that would have capped these fees was finalized by the CFPB in late 2024, then overturned by Congress in 2025 before it ever took effect. So at this tier, the fee structure remains largely what it's been for years. Cross a few $1,000s, and the fees usually stop. Most banks waive the monthly maintenance charge once you keep a modest minimum, often somewhere between $1,500 and $5,000, or maintain a regular direct deposit. But nothing changes beyond that. You're not charged for existing, and you're not offered anything extra either. This is the tier most working adults with a steady paycheck actually live in for years. The bank's app works the same, the routing number is the same, the interest on that checking balance is close to zero either way. At this level, you're functionally invisible to the bank, which, compared to the tier below, is actually an improvement. It's worth sitting with how long this tier actually lasts for most people. A steady paycheck, a modest emergency cushion, no major windfall. Someone can realistically stay right here for a decade or more, and the bank has no reason to treat them any differently on day 1 versus year 10. The tier isn't a waiting room before something better. For a lot of households, it's simply where things settle. Here's where most people assume nothing changes until they're rich. That's not quite true. Somewhere in this range, a high-yield savings account, not the bank's default savings product, which often pays close to nothing, can start paying a meaningfully higher rate, sometimes 4 to 5% annually, depending on the year and the provider. The gap between a checking account earning 0.01% and a high-yield account earning 4% on $50,000 is over $2,000 a year in interest you're simply not collecting if you never moved the money. This tier isn't about the bank treating you differently yet. It's about whether you're using the accounts available to everyone. Drake and Daniel can have the identical balance here and end the year in very different places, purely based on where that money sits. Run the actual numbers, and the gap gets harder to ignore. $10,000 sitting in a checking account paying 0.01% earns roughly $10 in interest over 10 years, effectively nothing. That same $10,000 in a high-yield account averaging 4.5% over the same decade grows to somewhere around $15,500, assuming the rate holds roughly steady. At $50,000, that decade-long gap widens to tens of thousands of dollars. None of this requires a new job, a side hustle, or a single extra dollar saved. It's the exact same money sitting in a different account. This is also the cheapest fix in this entire video. Opening a high-yield account usually takes minutes online, often with no minimum balance and no fee, which makes it strange that so much money still sits earning close to zero out of pure inertia. $150,000 is where one major bank's premium tier actually starts. Chase Private Client requires a $150,000 average daily balance across linked checking, savings, and investment accounts to waive its monthly fee and unlock the program. A dedicated banker, fee-free wire transfers, and preferred rates on some lending products. Below that number, that same banker isn't calling you. Above it, they are. This is the first point where the bank is explicitly choosing to build a relationship, not just process transactions, and it's not because $150,000 makes you wealthy. It's a specific, published number a bank picked because it's profitable enough to justify the staff time. It also isn't only about service. Chase publishes an actual mortgage rate discount tied to this tier. 3,125 percentage points off for $500,000 to just under $1 million in combined balances, and 0.25 percentage points off above $1 million. On a typical 30-year mortgage, a quarter-point rate difference can mean tens of thousands of dollars in interest saved over the life of the loan. That's a real number, not a soft perk. At $200,000 combined across deposit, retirement, and investment accounts, Citigold, Citibank's mid-tier premium program, becomes available, bundling banking and investment relationship management under one advisor rather than treating them as separate departments. The number matters less than what it represents. Enough total relationship value that the bank finds it worth coordinating across account types, instead of leaving you to manage each one separately. For most people, hitting a number like this happens gradually, a retirement account growing alongside regular saving, not from one windfall. The bank's tier structure just quietly catches up to wherever your existing accounts already are. This isn't a Chase and Citi thing. Nearly every major U.S. bank runs some version of this. Bank of America restructured its entire loyalty program in May 2026 into BofA Rewards, with 4 tiers based on a 3-month average balance. Member below $30,000, Preferred Plus from $30,000 to $100,000, Preferred Honors from $100,000 to $1 million, and Premier above $1 million. Wells Fargo runs a similar model. Its Premier Checking waives a $35 monthly fee at $250,000 in linked balances. The specific numbers differ bank to bank, and they do change over time. Bank of America's own restructuring this year is proof of that. But the underlying shape is nearly universal: a low tier with fees, a middle tier that's fee-free but unremarkable, and 1 or 2 upper tiers where the bank actively works to keep you. At $1 million combined, Citigold Private Client, the tier above standard Citigold, opens up. A dedicated relationship team, estate and wealth planning coordination, and access to lending terms not offered at lower tiers. This is the range where the bank treats you differently, stops being a feeling, and becomes a documented, published program with its own name. The published perks get specific here too. Up to $400 a year in cashback through a subscription rebate program. No foreign transaction fees, unlimited refunds on non-Citibank ATM fees worldwide, and access to Citigold lounges in select cities. None of it changes the balance itself. It's the bank spending a fraction of what that relationship is worth to it on keeping the client comfortable. It's worth saying plainly, none of this changes how much your money is actually worth. $1 in $1 million account earns the same return as $1 in a $500 account, all else equal. What changes is service, access, and how much the bank is willing to proactively help you use that money well, which is valuable, but it's not the same thing as your money working harder. Here's something that actually matters more than any relationship tier. FDIC deposit insurance only covers up to $250,000 per depositor, per bank, per ownership category. Once combined balances at one bank cross that line, anything above it isn't federally insured if the bank itself fails. This is exactly why, at higher balances, spreading money across more than one bank, or using different account ownership categories, is a real, practical step, not just a bank relationship perk. A dedicated banker at $1 million can help structure this properly, but the underlying rule applies at any balance above $250,000, whether or not a bank ever mentions it to you directly. Push all the way to $25 million and the service model shifts again. Dedicated family office-style teams, direct access to trust and estate specialists, and lending terms built around a specific balance sheet rather than a standard product menu. At this level, the bank stops feeling like a bank at all. It functions more like a private advisory firm that happens to also hold your checking account. It's also, by a wide margin, the tier fewest people will ever personally experience, which is exactly why this every level of wealth format keeps performing well across the finance niche. It's not aspirational fantasy. It's simply showing people a system that already exists, quietly, for the small number of accounts that qualify. Here's the part worth remembering after all those tiers. The actual mechanics of banking, deposit insurance, routing numbers, how interest compounds, don't change at all based on balance. What changes is entirely about service layered on top, dedicated people, waived fees, and proactive outreach. None of it requires being rich in some abstract sense. The $150,000 and $200,000 thresholds in particular are within reach for a lot of ordinary savers over a normal working decade, especially once retirement accounts are counted toward the total. It's also worth knowing this whole tier system is a big bank convention, not a law of banking. Credit unions run on a different model entirely. They're member-owned, and rates on savings and loans are often better across the board regardless of balance, without a separate premium tier to unlock. The trade-off is usually a smaller branch network and fewer high-balance perks like dedicated wealth teams. Neither model is universally better. It depends on whether you value tiered service or consistently better everyday rates. The one action item that's actually useful here, check whether your own accounts already qualify you for a tier you're not using. Banks generally don't proactively tell you when you cross a threshold. You have to ask. Most of these thresholds aren't just checking and savings. They typically count combined balances across linked checking, savings, CDs, and personal investment or retirement accounts held at that same institution. Someone with $40,000 in checking and savings and a $120,000 rollover IRA at the same bank may already be sitting well past a fee waiver threshold without realizing it, simply because they never linked the accounts or asked a banker to check. That's a 5-minute phone call, not a financial overhaul. There's a simple economic reason none of this gets announced. Servicing a low-balance account costs a bank roughly the same, whether that account holds $200 or $8,000. Mostly fixed costs like statements, fraud monitoring, and basic support. Above a certain balance, the profit from lending against those deposits and cross-selling other products starts to justify paying a dedicated person's salary to manage the relationship. The tiers aren't arbitrary. They roughly track where a bank's own economics flip from cost to serve to worth actively retaining. None of that is a reason to feel resentful about it. It's just how the underlying business works. But it is a reason to stop assuming your bank will proactively act in your interest. At every tier, the account terms are published. Nobody's hiding them. Most people just never go looking. Below $500, you're a cost center. Between $500 and $10,000, you're invisible, which is neutral, not bad. Somewhere in between, a high-yield account quietly does more for your money than any relationship tier will. At $150,000, Chase's private client tier opens a dedicated banker. And Bank of America, Wells Fargo, and nearly every other major bank run their own version of this same ladder, with their own numbers. At $200,000, Citigold bundles your whole relationship. At $1 million, Citigold Private Client adds estate and wealth planning, on top of the $250,000 FDIC insurance limit that applies no matter which tier you're in. And past $25 million, it stops looking like retail banking altogether. The dollar amount changes the service. It doesn't change the math, and it doesn't change what your money is actually worth. This video is for educational purposes only and is not personalized financial advice. If this helped you understand what's actually behind the premium banking pitch, subscribe. New video every week. Check your own linked balances this week. It costs nothing to look. Next up, The car payment trap that's quietly stretching millions of Americans into 84-month loans without them noticing.